video, we want to discuss the Elliott wave. I'm going to explain this in its basic form, and in our advanced videos, I do a lot of work with Elliott wave. I do a lot of work with market geometry. So what I suggest after this video, go look at our advanced videos. I have a lot of old stuff that has market geometry and harmonics and Elliott wave, where you can take more advantage if you find it something important. I feel Elliott wave is critical in trading. It is very critical to understand the type of trend you are in, whether it's a higher time frame, lower time frame, but I'm going to show you the basics, and then please go look at the other videos we have and do more research. So let's take a look here. Okay, so typical Elliott wave is, let's just put this as the last move down in a trend. Market tends to move up off of a low. Now whether it goes this high or this high, it's irrelevant. It's that first retracement that becomes important. Now there's two types of retracements that can happen, and one is a deep retracement and one is a shallow retracement. A shallow retracement here would be considered 618, 618 retracement, and a shallow is a 38.8 to 50, sometimes even 24%. But most of the times you'll get a deeper retracement. The more shallow the retracement, the more pronounced or aggressive it will be to the upside. You will see further shallow retracements. So let's take a look at the deep retracement. Let's take a look actually at two types of trends. So first one here, and then market goes up, and then market has a deep retracement. Actually, let's do this. Actually, let's fix that. I have a better idea. Let's do it as a line so it's out of our way. Okay. So, market has a move down and then a move up. Okay, they always have that first leg up off the lows. Then in normal Elliott wave, you would get a deep retracement. It may come 618, it may come 50%, anywhere in that zone. And then the market will expand. This leg right here, and then it will come down one more time, and then expand up. So this is the basis of what we call an Elliott wave. The low, which is called it's a 0, and then this is the 1. This is the 1, first wave. The 1 to 2 is called the second wave, and then wave 3, wave 4, and then wave 5. This is a typical Elliott, what they call a 5 wave. 5 wave. And a couple of principles you want to learn from this, and again, this is basic, we're not going to get so deep into it, is that wave 2 to wave 3 would be the largest wave up. Wave 4, the retracement down must stay above wave 1. So when this market comes down, it must stay above wave 1 to stay valid, and this would be a large wave up. The other thing is that typically you would have maybe a sharp move down where the market just fails, and then you would have a correction down on the 3 to 4 wave. The 5th wave, typically you get a big move up, but we also have waves that go this high and then go sideways. So that is basic Elliott wave in its simplest form. Looking at the charts, if we were to put this now, actually